Hello and welcome to Smartkarma's Webinar Wednesday. I'm Michael Tegos. Today I'm excited to welcome Phil Rush, who will take us through inflation in the euro area as HICP wage changes are set to keep causing surprises this year, according to his forecast. And he'll be able to tell us more about that in a second. A few words about Phil. He's the founder and chief economist of Heteronomics. Until the launch of Heteronomics in November 2016, he was Nomura's senior European economist and the chief UK economist there since 2010. Before that, he was UK economist at Barclays Wealth, where he also developed strategic asset allocation models for their market return portfolios. Philip started his career at Lehman Brothers, covering the UK, Scandinavian, and Swiss economies. And in January 2018, he had a book published on his fundamental framework called Real Market Economics. Before we start, as always, please feel free to send in your questions for Phil throughout the webinar using the Q&A button on your Zoom app. We will do our best to get to the questions during the Q&A section. Please do not reshare the contents of this webinar without permission. As always, you will find a recording in the page that you used to register. With that out of the way, Phil, thank you very much for being with us today. I will turn it over to you.
Yeah, thank you, Michael, and thanks everyone for dialing in this morning. We'll try and go across the various angles of this story over the next 20 minutes or so that you've got some time for questions, and we can always develop some of these concepts more in that Q&A, or move on to some of the other non-directly inflation topics that we're currently talking to clients about. Now, in terms of the European inflation picture in particular, there are these three broad stories that we're going to address today. The first one is around the weight changes that occurred in January. Now, that was a significant contributory factor to the big spike that occurred, and it's something that we caught and the consensus didn't. Now, the consensus generally models inflation in quite an aggregated way, particularly when it's looking further forward, because it assumes that weights don't really move very much, and that's the safe way of doing it. But that doesn't work in practice. And in particular for this year, with very large weighting changes, it is going to cause substantial changes in seasonality and substantial changes that catch the consensus off guard. The second broad story that we'll talk about today is around monetary policy's role in the overall policy framework nowadays. We see it as an increasingly defensive instrument where it still has power to support inflation, but it's really via accommodating the degree of fiscal accommodation that is consistent with the target, rather than being able to directly, in and of itself, stimulate the economy back to deliver an inflation target. And that creates some really relevant disparities between how you might see what's happening in the US versus what's happening in the euro area, with the UK kind of in the middle. The third story, which is also a somewhat longer term one, is around deglobalization. Now, with kind of Brexit behind us and Trump out of the White House, there's a tendency for people to think that we're returning to some kind of old multilateral order with populism defeated. Whereas even with the mix that we've got now, there is still a significant pressure towards deglobalization, and there are quite substantial risks that this triggers a material schism, a break in global supply chains. Now, that matters on the inflation side through the Phillips curve in particular, where you could look at globalization as both lowering and flattening the Phillips curve. So to the extent that you get this deglobalization, or unfortunately the risk of this schism, that would cause a significant increase and steepening of the Phillips curve, generating more inflation for a given level of unemployment or change in it. Now on the weighting side, this chart here is showing across the various countries in the euro area the impact of those weighting changes that occurred in January. And they're pretty punchy, as you can see, in particular for Germany there. It was worth almost 45 basis points for the euro area. And that kind of broadly equates to the size of the surprise that occurred on the day. Now, the reason that this came about was because Eurostat, in its infinite wisdom and apparent eagerness to distort the data, decided that rather than use the conventional expenditure data for updating the inflation basket, they should instead get all the national statistical institutes to use expenditure data for 2020 extrapolated to the end of the calendar year. So it's basing the basket of goods and services on crisis distorted levels of expenditure. And in practice, that means that a lot of seasonal stuff gets absolutely crushed. Clothing in much of the euro area is down in some cases by like 2/3. Package holidays in Germany, which is a hugely seasonal thing, is down a lot more than that. And things like petrol are also down. So as we see things like at the moment with shocks in petrol prices from OPEC's pressure and the oil price going up, that's actually having a smaller impact on inflation than it would have done in the past, because petrol consumption was very low last year when no one was traveling. And so the elasticity of these things has been fundamentally changed by Eurostat saying we should use expenditure data from last year to base the consumer basket on. Now, this is largely a seasonal story, in as much as if you're reducing the weight on very seasonal things, okay, on months when they would seasonally go up, you're going to dampen that effect, just like you're dampening the effect of a seasonal decline. And so over the course of the year as a whole, it's nowhere near as inflationary as that initial spike in January. And so the orange bars you can see here are showing the impact on our forecast that came about from these weighting changes into December 21. And you can see that it's much more mixed and much smaller because of this sort of seasonal effect. Now, if we kind of hone in on the euro area market, which is, as you may know, a directly tradable market, this is showing the profile on the monthly rates that comes about just from this weighting change at the moment. So you can see the big move in January, but across future months, how these are distorted. So February, which we've now got the flash for, that was more than a 0.1 downside effect. And indeed, the early consensus for the February flash was off by a bit over 1/10. It was only when you got more of the constituent countries come out that the consensus was able to get dragged to where our forecast was on this already. And it's a similar story in March. It's a similar story, slightly more so in April. In general, these moves are to the downside over the next five of the next 6 months. The move in November, which is almost, we're kind of rounding to 3/10 on the upside, that is something that I suspect will catch the consensus off guard at that time, as indeed will the upside in September. The consensus just doesn't have a very good feel for how the various different weighting changes are going to balance out against each other. And so they're likely to be repeatedly surprised by these kind of effects, as well as misjudging the impact of other shocks because they just don't have it properly identified. We get it in our framework because we model at a very disaggregated level. Specifically, our headline euro area model is actually a weighted average of 1,692 subcomponents, and we have many hundreds of other explanatory variables that are feeding into our platform. So we actually put more. We actually have more components being forecast, so more granularity in it, in somewhere like Cyprus than most people would put in somewhere big like Germany, and that helps us to capture all these subtle changes in a way that helps us to outperform the market. I won't dwell too long on this, but just to illustrate here with French inflation, which is also a tradable market, you can see on this top left chart the kind of consistent outperformance of us versus the final consensus on the flash releases. 1 percentage point of outperformance over the last year cumulatively. We've beat on the last 2 releases as well so far of this year, and we're able to do this because we combine economics with data science on a large scale cloud hosted machine learning platform. So we are pushing the technological frontier in the way that we run this kind of research, and I believe that's showing in our outperformance on things. This chart showing our current forecasts and how we see all these effects balancing out. So with the next month's release in the euro area, we do get quite a substantial step up, 60 bips up. That's driven by base effects, so that aspect shouldn't be overly surprising to people. And then you get another move slightly above the target over Q4. Now the ECB will have been caught off guard by this latest spike, and that is dampening some of those dovish pressures. I'd also note here, because this is showing our UK, Swedish and Norway forecasts, which are all running on the same kind of platform, we only share publicly our UK forecasts, where we've been #1 ranked on RPI for years. Norway this morning, we were 60 bips wide of the consensus as of last Friday. The consensus drifted a couple of tenths in our direction, but we still smashed it. 60 bips off of consensus and only 7 basis points off of the target, off of the outcome. So our kind of very granular framework genuinely does work, and it's helping our clients on this. Tomorrow we get the ECB with their take on these inflation pressures. With the ECB, as indeed how we do it with the Bank of England, Norges Bank and Riksbank, we model their forecast changes as a function of historical forecast changes. So we throw in various explanatory features from market variables and surprises, and that helps us to understand from their realized forecast changes what the most likely shift is. Unsurprisingly, given that Q1 is on track to surprise their forecast by 80 basis points, there is a substantial upside shock here that is this factor of urging some constraint against what might have otherwise been some dovish pressures. But the medium term isn't materially changed by the recent events up to the kind of cut-off window. So I think they'll be resisting some of the dovish pressures. I don't expect them to be pushing back against the increase in nominal yields that's occurred recently. All but one of the ECB board members who's spoken recently has been fairly accommodating of the move that's occurred so far. So I think you'll see Lagarde broadly welcome it as being kind of vindication, if you like, of their delivery of inflation, while also noting that they will keep their eye on their compass, as she likes to call it now, being not wanting to see this get out of hand to the point where financial conditions are materially tightening things in the real economy. If we move on to the kind of two broader themes I mentioned at the start. So one of them is around this fiscal versus monetary policy mix. Now, with how low yields have got, both in policy rate space and the short end of the yield curve, there is very, very little room for monetary policy to stimulate through those conventional means anymore. And that leaves us kind of hoping for QE to pick up the baton and work. But the trouble is that there's still very little room to move market yields with QE. And so the kind of conventional transmission mechanism is, dare I say, broken in this environment. What you're trying to do by moving interest rates is to shift consumption and investment in time. You want to encourage people to do that activity now rather than in the future. But when you're looking at such minimal changes in rates, there isn't that incentive to shift that consumption and investment. Arguably as well, we are now living in the future that we had previously pulled consumption and investment forward from. So there's much less room to do it through that channel. The hope that you get from a more kind of American monetarist channel would be that all the base money that they chuck in the system from QE gets multiplied up, and that then stimulates activity, like it trickles out into the real economy and becomes relevant. But it just doesn't work like that. Like this chart here is showing since 2006, base money, a logarithm of it on the x-axis against the money multiplier. Now, if this was a channel that policymakers could exploit, you would want to see a horizontal line here, as in as base money goes up, that gets multiplied up. It's a constant that can be exploited. But what we get is a very sharply downward sloping curve, because policymakers create the money. There is no reserve shortage. It doesn't trickle out. What does it do? It inflates the assets. Yeah, I believe that the kind of classical thing that inflation is everywhere and always a monetary phenomenon, but it matters where that money is going. And that money is going into bond prices primarily, with a bit of portfolio rebalancing into other asset markets. It is not going into the real economy, with one exception at the moment, and that's the US. But it isn't trickling through because of monetary policy itself. It's happening because of a weirdly late fiscal stimulus that's occurring there of an inordinate size. So by having large-scale fiscal transfers in that stimulus, that then is creating that demand, bringing it forward to the present, and monetary policy is accommodating that. So that's why you're seeing that mix. That isn't what's happening in the euro area. We have a very small kind of national stimulus with this new European package on top of it. The UK is kind of somewhere in the middle on this, but with plans to close that deficit a little bit in the future. So this is well worth keeping in mind, that this mix of inflation being generated increasingly through the fiscal channel with accommodation from monetary policy. A final point I wanted to make is around deglobalization. Now, traditionally, we've looked at this in the opposite way, globalization. And it's arguably one of the reasons that in recent decades, much of the Western world has struggled to generate inflation, even when unemployment rates have pushed lower than they had done in the past. The ability for economies to specialize and utilize capacity from abroad was able to help lower Phillips curve relationships. But it was also able to flatten those relationships. So for any given change in unemployment, you weren't getting anywhere near the same change in inflation. You can look at this in the sense of if an economy is running a bit hot, well, there's another supplier somewhere else in the world that you can go to. So you're no longer anywhere near as constrained by domestic factors. The domestic output gap loses relevance relative to a global output gap. And this process has gone on for perhaps a bit longer than many would have initially expected. Like as China's agricultural labor moved more into the cities and we went past the so-called Lewis turning point, you might have expected it to cease to be able to export disinflation in the way that it had during the 2000s. But in practice, supply chains have also moved out to other countries in Asia, and that's allowed us to kind of continue this globalization trend, moving Phillips curves down and flatter, allowing a relatively disinflationary environment in much of the West. But now we're on the deglobalization strand of this. Brexit was one example. Trump's policies were another. And contrary to what many people seem to be hoping, I don't believe that there's likely to be a wholesale return to the kind of multilateral world order that preceded Trump and Brexit. There are serious concerns around China's role in the ecosystem. You can it's not hard to find regular statements from Biden himself, his team, or the Senate, looking at a need to have independence in their technology supply chain. You can see similar arguments across most of the world when it comes to health and vaccine supply chains as well. There's been a reperception around what is a kind of key national industry and the value of keeping that stuff onshore, and as a result, we're seeing a reverse of that globalization trend. This chart here is not my forecast. This is actually an OECD forecast. So just to be aware that there is an element of this that is kind of mainstream, but the implications are not following through in mainstream forecasts at the moment. So this chart is import penetration. You see for the UK that the import penetration, essentially the share of imports in domestic in GDP, that's been going down and is forecast to continue going down to levels from the noughties. And I think there's an increasing risk that we get a more wholesale schism where there is a break between a kind of US-led world and a China-led one that kind of reverses this favorable globalization process, causing Phillips curves to rise and steepen back again. So with that, I'll kind of leave it open for questions, especially as I've overran by my own time by a few minutes. Thank you.
That is perfectly okay, Phil. Thank you very much for your presentation. As Phil said, you can send in your questions using the Q&A button. If you want Phil to elaborate on anything presented here. I guess, and as we wait for any questions from the audience, Phil, you talked about the deglobalization trend that we are seeing, and you do seem quite bearish on the prospect of the trend reversing. Do you think that we'll see this trend develop over the next 2 to 5 years, or is it kind of like a longer term development, do you think, based on what we're seeing?
Yeah, I think it will continue over those shorter, more investable horizons. There is ongoing desire from the Biden administration to create this independence in its whole technological supply chain, and there's a risk that China lashes out at this and utilizes leverage while it has it. We've seen cases before, for example, with Australia, where China is quite happy to use its strategic control of things like rare earth minerals to exert pressure on its erstwhile trade partners. So rather than wait until the US is immune from such pressures, it seems quite plausible to me that the geopolitical aspect of it comes to bear sooner, and China uses that pressure while it's got it. If we were to be in that world, then you're looking at the kind of hard, the schism that I mentioned, where both sides are kind of trying to scramble to adjust, and that would be a significant supply shock if it was to come about. That isn't in my forecast, that shock. The trend, the deglobalization trend is an aspect of it, but I think investors need to be aware of that risk and watching that risk, because if it occurs, it will be a really substantial one.
Given that we're seeing some of that, I guess, quote unquote nationalism in certain European countries as well, how do you think that balances out with ECB's policies going forward?
Yeah, so it helps when in a way that Italy has done it, with Draghi as the poster child for European unity, when he's going out and using European controls to restrict exports of vaccines. It does provide a bit of cover to others, and means the ECB is going to be quite accommodating of what Draghi does and less critical of others. You see things like in the FT where they're wonderfully apologetic for him, whereas if we were looking at Orban doing the same, it would have been quite a different story. So I don't think they're going to be rattled by this. They'll continue to buy peripherals without constraint, and you can see the way that the yield moves across Europe have gone. This isn't a case of spreads widening between member states, or even really real yields moving very much. It's much more about inflation expectations moving back up to a level less inconsistent with its target. So it's kind of it's like the ECB is being able to import some policy credibility from the US.
I know that you have looked a bit into basically we're seeing now all the vaccination efforts taking place in Europe, and I know you've looked a bit on basically a question of whether it will aid UK or Euro area economic performance this year. Where do you sort of stand on that?
Yeah. So the US is on track to far outperform the rest of Europe, aided by this large fiscal stimulus, accommodated by monetary policy. I'm much gloomier than the consensus on UK growth, and I'm, I suppose, gloomier in general over the medium term about the kind of Western outlook. for the UK gloomy story, that's much more about balance sheet damage from the COVID restrictions mixed with behavioral changes from households and governments, like the revealed reaction function to viral threat is much more aggressive now, and that's not going to just magically go away. Lockdowns and that are here to stay, and in particular the UK has got these lingering pressures on restrictions that are more extreme than what we're seeing elsewhere in the world, despite a relatively advanced vaccination program. So the market's pricing the UK as though it's going to massively outperform, when actually, like on the back of this vaccination program, whereas actually the UK is not reaping the benefits of that. You can see in a wide variety of metrics that the UK's Q1 is far worse than elsewhere, and its recovery is just not really occurring yet. Yeah, so kind of US outperformance this year, UK disappointing the consensus. I'm at the bottom of consensus for 2021, and some generally gloomier views longer term on things like balance sheet damage.
That's what everyone likes to hear, I'm sure. An attendee asks, is there any specific European country that stands out from the crowd in terms of economic balance sheet and outlook?
So for me, relative to market pricing, the UK is the one that stands out, because there's an assumption that, well, in fact, I've got a slide on it here. There's optimism on the consumer side here, where because people have been paid to stay in their jobs and by the government, and they've not been, while output's fallen, there's and expenditures have fallen, there's a big pool of savings that's accumulated. So there's a view that actually the balance sheet story, particularly in the UK, goes the other way, and I think that is just fundamentally wrong. The people who've accumulated increased savings balances in the UK are wealthier people and retirees. Retirees and people who are approaching retirement have extremely low marginal propensities to consume. The fact that long-term rates are lower now than pre-COVID means that if you're buying an annuity to provide income in retirement, you'll get a lot less than you had in the past. So that savings is not something that you can go out and spend. And this chart, the reason I went to it, is that this is actually from a similar kind of savings survey, looking at who's accumulating those balances. And it shows you that people are saying they're not going to spend more, despite having those savings. Actually, they plan to spend a lot less next year. So it cuts the other way because of this kind of lingering fear, the realization that these kind of lockdowns can happen unless you need to hold a higher precautionary savings balance than before. The UK also, relative to European corporates, we've had much smaller direct transfers. Like if you're looking across European bankruptcy data, you can see that they pretty much stopped. That's partly because, like everywhere in the world, courts have struggled to process bankruptcies, but it's also because there was just a lot more direct support to corporates to kind of keep them in business than has occurred in the UK. The support we've had here is to workers through the furlough scheme and in government spending on not always particularly effective programs. It's not support to corporates, other than slight liquidity support through loans. But a loan is still something that sits on your balance sheet. There's an opportunity cost to it. If you've run down your cash balances to remain in business and you've taken on a loan with a government guarantee, well, you can't then go and take out a loan, the same loan in the future, to fund some more productive investment. So the mix of policy support in the UK has left more balance sheet damage, I believe, on corporates than elsewhere in Europe. So I think that there's more of a problem here, and also relative to market pricing in particular.
Got it. Well, that's just about all the time that we have today. So thank you very much, Phil, for your presentation and for tackling our questions. Please note that Phil is available for bespoke research requests or premium services. So please contact your Smartkarma account manager in this regard. And if you have any other questions or comments, please email us at research@smartkarma.com. Thank you everyone for attending today. And Phil, thank you very much once again.
Thank you.